Welcome back to Dukascopy TV. I'm Elaine Stenson. I'm joined in the studio now by Ron William, who's founder and principal market strategist with RW Market Advisory. Ron, you're very welcome to the studio.
Thank you very much. Happy New Year.
Happy New Year. So we'll start with the S&P500, where there's been a sharp decline as it has just entered a key cycle.
Yes, well, the key cycle window is roughly about a week plus or minus a few days, the week that had passed and a few days ahead. So that had been an area, an inflection point that I've been looking for. But also from a macro perspective, we have to keep in mind that this is still that 5-year record cyclical recovery from 2009. So at some point we were waiting for some kind of ripple effect to take place where the market would start to unwind. From an event risk perspective, of course, tapering is still top headline here, still providing some downside pressure in the market. One key point I'll mention is just the support levels for some traders who might be looking for those areas. Support levels at 1737, which is roughly where the market is holding at the moment, but beyond that 1703 and 1669. These are key Fibonacci levels to keep an eye on.
And the dollar yen is back under its peak level during the summer.
Yes, absolutely, and dollar yen's been a favourite trade for a lot of investors and traders for so long now, but it's also been a key measure of risk appetite. So what with the S&P coming off a little bit and various other risk appetite markets, the yen is providing further indication of this unwind of positions. Now, from a technical perspective, like you said just now, the big move up has failed to hold above its summer peak levels. So we're seeing this as a potential structural reversal in the short to medium term basis, and watching key levels at 101.11, which is roughly where we are now, 99.68, and then 98.25. Again, 3 key Fibonacci levels to keep an eye on.
Okay, and staying with the yen, the South African rand has been the worst performer against the Japanese yen.
Well, in currency world, of course, there are many pairs to take a choice of, and the following chart is a measure of relative performance of different currencies versus the Japanese yen. So it's a new, unique way of looking at things, but basically follow the arrows clockwise, and it basically tells you whether the market is leading, weakening, lagging, or improving. And you can see there just the outlier as the rand yen just in the bottom left-hand corner, weakening the most against the Japanese yen. But what that also suggests is that maybe going forward that there might be a better chance of recovery and mean reversion on the rand.
And finally, Ron, gold, which is a good measure of safe haven trading, has been steadily rising over the past week or so.
Well, certainly, gold is the flip side to this story. So we've been talking about risk appetite unwinding, and of course gold is more the safe haven trade, finally actually trading as a safe haven in the very short term. So big picture gold has obviously been unloved for well over a year or so now, having drawn down by 30%, so a lot of capital lost there. But now we're starting to see early signs of a mini recovery after actually achieving a technical projection just there. And what we need to still see is evidence of further bullish momentum above those key levels 1360 and 1428, which are the prior swing highs.
And one final question, Ron. Do you think expectations for the US economy were too high for 2014?
Well, one great measure of that is investment sentiment, which I keep an eye on, and they are at record optimistic levels. And the flip side of that is the VIX, where you have, I mean, you've had record lows on that. So I think that we're at extremes of all of these areas, and so we should be seeing a change in the near future.
Okay, Ron, thank you very much for joining us today.
Thank you.
And that's all we have time for now, but do check back later for further updates and interviews from the TV team. Bye for now.